Welcome. I'm the last speaker in the way between you and Peyton Manning, and I will not be able to impress you nearly as much as a two-time Super Bowl champion and five-time MVP, but hopefully you walk away from this session with something useful that you can apply in your everyday life in the finance world. Let me talk a little bit about myself first. So I'm currently the CFO of Fresh Products. We are a small company that manufactures air fresheners in Ohio, about $60 million in revenue. I will talk about them at the end of this presentation, but most of my conversation will be about prior employers that I've worked at that were growing rapidly, large, multinational, public companies with a variety of different products, industries, business segments. My career has taken me across many different companies. I've often viewed finance to be a transferable skill set, one that you can take from one place and go somewhere else and apply it. So because of that, I've been able to learn a lot of lessons, see some trends, and I would like to share some of those with you today. I'm also a member of the FP&A Council. AFP has several councils of industry practitioners, and we get together via a teleconference once a month, and we get together here at the annual conference to discuss issues that are relevant to the FP&A profession. There's also one for Treasury as well. If this is something that might be of interest to you, feel free to talk to me at the end of the presentation, and I can tell you more about the FP&A Council. Welltower and Zimmer, those are both multi-billion-dollar publicly traded companies. I was the leader at the corporate headquarters of the FP&A team, and Wrexham is a British-based packaging company. I was the leader of FP&A at their divisional headquarters for the United States. Now, on our phone, as our introduction said, we have an app for this conference. At the end of the presentation, you can get CPE credits by filling out a survey. Now, for this presentation, there's also live polling. There are 4 questions that you can get from this presentation within the app. Feel free to open up the app now and complete the first question, or even all 4 questions now if you want to skip ahead. And I'll give you about 30 or 45 seconds to do so, and then in the next slide, we can see what the results were from the poll. So I'd like everyone in the audience to think, when have you experienced rapid growth? Is it going on right now? I would guess that that's probably true for most of the people here. That's why you're here at this presentation. Or maybe it's happened in the past, or maybe it's never happened. Of the other presentations that I went to so far, nobody had live polling. So this is the first time that I've tried it, so we'll see if it works. I'm judging by people looking at their phones that they're still working on it, so I'll give you another 10 or 15 seconds or so. All right, it works. Good job, AFP. So about half of you said you're currently in a fast growth environment, and about another 25% that you've had this in the past and right now. And I think that's what I expected, not only from the people in this room, but in general as finance practitioners. There are many ways in which an organization can grow quickly, and throughout a finance career, you're going to face rapid growth. Where can you see rapid growth? Now, this might happen at an entire organization. So that's probably the first thing you think about when thinking about rapid growth environments. Facebook, for example, or Google, the big internet tech companies. These are companies that went from zero to multi-billion dollars very quickly. That's the first thing that comes to mind. But you also might acquire a division that is growing. So there are many examples of having a stable, slow growth company that then acquires a smaller growth, acquires a faster growth organization. So Microsoft buying LinkedIn would be an example of that. New products. This is something that's happening to me right now at Fresh Products. We have launched a new product a few months ago, and it's growing 100, 200, 1,000%. And finally, new markets. A lot of companies are in established, mature markets, but they decide to go elsewhere and try to find rapid growth opportunities in other countries or even within other segments in the same geographic area. Rapid growth can make you want to bang your head against the wall sometimes. Some of the challenges that you face might appear to be overwhelming. Now, what are some of the consequences of being unable to manage growth? So let me start with something that went very poorly. I worked at Monster.com during the internet boom from the years 2000 to 2004, and I was a senior FP&A analyst there. So I was not involved with the accounting department, I had nothing to do with stock options, but they had a stock option backdating scandal during that time. The executives would write stock options and change the dates based on what was the highest possible date, if it was to sell, or the lowest possible stock price when the stock was granted. This is actually not illegal. You may have heard some of this back in the early 2000s, but you have to disclose it, and you have to tell your investors you did this. Well, Monster didn't do this. In the pace of frantic growth, this was missed by most of the organization. What happened to Monster's stock price? It plummeted, and Monster was once an internet darling. Think about companies like Facebook or LinkedIn or Twitter. These all have natural network effects. These are companies where the buyers want to be on the same platform as the sellers, or people want to be on the same platform as their friends. Monster had that 20 years ago. They had big ads during the Super Bowl that would cost several $1 million touting their platform. But they were growing so fast, buying so many companies, because they were not taking that exact same platform and duplicating it in different countries. They were actually buying dozens, if not hundreds, of other .coms, trying to cobble together a job search empire. And it didn't work, and the company is now a fraction of what it used to be. And as a show of hands, this is not a poll, how many people have used Monster.com in the last year for a job search? Nobody raised their hand. So if you don't manage rapid growth well, it could seriously hurt the long-term prospects of your company. So during this talk, I'd like to focus on 3 areas in which you should improve your organization to do a good job of rapid growth, and that's people, process, and technology. I'll also talk about some pitfalls, things you want to avoid in a rapid growth environment, how FP&A can help, and finally some success stories from my personal career that have worked, and some current challenges that I have in my employer. I'd briefly like to discuss the FP&A maturity model. I mentioned in the opening that I'm a member of the AFP FP&A Council. We prepared this as a team about 2 years ago as a way to think about how is your organization positioned and structured to be able to solve FP&A problems. That framework that we put together as a team can also be applied to rapid growth. Why people, process, and technology? Well, people, process, and technology, these are capabilities to survive and thrive during growth. Those are the 3 lenses that I look at an organization to see, does it have the capabilities to succeed? And that's also very similar to the maturity model that we developed here at the AFP. And think about your accounting classes, whether you have a CPA or you have another undergraduate degree. You have labor and capital. That's what they teach you in your first debits and credits class. Well, that's people and that's technology. Process is what pulls that all together. People. So for our second audience poll, do you think you have the right the right people on your FP&A team? Do you think everyone is excellent? Mostly yes, a mix of good and bad, or we need a major overhaul. Now, all of these poll submissions are confidential, so we are not going to link your badge number to what you say. So if you don't like your team, no one else is going to know about it. I'll give you about 15 seconds if you haven't already completed the poll. It looks like everybody is completed or is mostly completed. Everyone is excellent. Only 18% gave that response. Well, if you have a great team, congratulations, but you are in the minority. Most people gave responses that either most of their team is good or it's a mix of good and bad. My experience is that there are good players in almost every team. No one says they have a team of all C players, but at the same time, you also need to look at, does every person on your team have the skills and capabilities to help your team be successful? And what is required for success in a rapidly growing environment isn't always the same thing in a stable environment. What are some challenges that a rapidly growing organization faces with regards to its people? Weaknesses become exposed. There's increased job complexity. Additionally, there's new technical skills that you might need. Now, do you train people for these new technical skills? Do you hire consultants? So let me give you an example of what happened in my current employer, Fresh Products. We surpassed a threshold where we were required to have a 401k audit because we had a certain number of plan participants and a certain number of dollar of assets in our plan. The person doing the 401k compliance previously wasn't trained in this, didn't have any understanding of what was required for ERISA statutes. We got audited, and what we realized is we were not putting money in the 401k plan in a timely fashion. The actual guidelines say you should put the money in whenever practically possible. It's a vague definition, but generally that means within a couple of days. We were doing it within a few weeks, so we had to pay a big fine. So my challenge is, what do I do about this? Well, here at the AFP conference, I'm going to sessions trying to learn about 401k compliance. This is new to me because my prior career was FP&A. We also hired an advisor to help my controller learn some of the compliance things that we were unaware of previously. When you reach a certain stage in your growth, often there are new requirements. Additionally, if you're in a small environment, you might do things manually. Doing things manually doesn't scale. At what point do you invest in new technologies or new skills to scale? So for example, again, current employer, Fresh Products, we have a tough balance between, do we automate, do we do things manually? There's a lot of situations where the cost benefit doesn't make sense, and we're still doing things manually. But there's other examples. For example, we put a lockbox in this year that was a pretty obvious one that we should have been doing for a long time, where the safety and the non-financial costs, in addition to the financial costs, that mix made sense for us to add the new technology. Assessing your people. Are your people ready for the next phase of your organization's existence? Now, I have had situations where I had to do all 5 of these things in my career. You can coach people. You can sit down with them and mentor them and train them. Some people are open to receiving coaching, other people's less so. Some people are open to it but don't have the aptitude to actually receive the coaching. You need to make that judgment call if you're in a management position. You can retrain people, send them to a conference like this, have them do some online training. If your growth pattern is taking you in a place where it's more of a system that you can train them on, or based on my prior slide, some compliance issue that they need to be aware of, yes, you can definitely train them. You can shift responsibilities. There might be certain people that have the right skill set and the right temperament for your new environment that were not appropriate for the previous environment, and vice versa. You can always replace people. That's usually the most painful thing to do. I've tried to limit that and do that as infrequently as possible. But as a manager, you must realize if you can't do any of the first 3 things, you might have to replace people. And the last thing is hire a consultant. Now, consultants are expensive. But that is one of my preferred approaches. I've done that a lot to fill gaps in my organization. Why? Because consultants, they have the necessary skills and expertise, or at least you hope they do. You do have to interview them carefully, ask for references, find out, is this consultant really the expert they say they are. But you can buy people's time in small amounts. You don't have to hire them on, go through an interview process, make them an offer, give them benefits. You could say, I need 12 hours of this person's time, and we're going to absorb that knowledge into the organization. So for me personally, I like the hire the consultant option. Some companies don't like consultants. Sometimes it's difficult to get them approved, but I think the right value proposition can really make sense when it comes to consultants. Hiring. As I previously said on the last slide, it's easy to hire people, difficult to fire them. That's true in this country. It's even more true internationally. So be very careful before you decide to go hire someone. Your growth forecast needs to be realistic, and the hiring has to be aligned to it. So how do you know if your growth forecast is realistic? That's some of what I'll be talking in the future, in the subsequent slides. But keep everyone connected in the organization. Talk to HR, talk to the business unit leaders, talk to finance. You need to let each of those people know where you see the company going. If you think you're going to double sales next year, HR needs to know that. We are dealing with that right now at my current company, Fresh Products, because we have a lot of plant workers, and it's very difficult to hire people in the manufacturing plant when you have less than 4% unemployment. And if you're only paying $10, $11, $12 an hour, a lot of those employees can go down the street, go to McDonald's, go to Target, go anywhere. And we ran into a situation where we were running a lot of overtime because there was a disconnect between the growth forecast and the hiring forecast. And I made it a point to sit down with the head of HR regularly every month to try to close that gap, and we ended up sending out a weekly email tracking overtime hours in the plant, and eventually we got that down to about 2%. So that was a good success, but we could have done it sooner. We incurred extra costs for a few months because those two things weren't as closely connected as they could have been earlier in the year. Now, if you're going to expand internally, there's some more nuanced considerations as well. That word's supposed to be international, not internal. My apologies. If you're expanding internationally, you need to know what the local labor laws are. If you've never done business in that country, hire a consultant. That is an easy way to make a lot of mistakes very quickly, is going into a new country and not knowing what you're doing. And it's very expensive to fire people. So before you go into another country, think about, can I lean on one of my customers or a joint venture partner or a consultant? Is there another resource available that I can use before making that decision? Because that is a very binary yes, no. Once you make that, you can come back from that, but it's more difficult. Finally, empower your new employees. Now, this is true of any new hire, but when you hire somebody, you need to make them aware of what's going on in the business, how it's growing quickly, and what your expectations are to make them successful. Now, for the second key challenge, I'll talk about process. So for the next audience poll, do you think your processes in your organization are well documented and understood? And I hope we don't have too many responses to D, what documentation, but we'll see. We had 17% for what documentation. Well, that's a little bit concerning. But only 2% said very well understood. Process is something that pretty much every organization struggles with, even large public companies that have lots of SOX requirements. But especially this is true when you're growing fast. People don't have enough time to write things down on a piece of paper or in a document to say, how the heck do we do our jobs effectively? Why is that? Things change too quickly. Now, I'm a CPA, and the CPA in me wants to write everything down. I can be a little bit crazy. When I travel, even if it's personally, I write every expense in an Excel spreadsheet. I can tell you how much my vacation in California was 5 years ago, because I wrote the whole thing down. Some people are laughing because you know you do it too. You know you do it too. You don't have enough time to do that when you're in a fast growth organization. And because things are changing, the way you do things now might be different than the way you do things 3 months from now or a year from now. It doesn't make sense to document everything. And your previous processes might not apply anymore. Maybe you have to get rid of them, maybe you have to modify them, or maybe there's no process, so you have to create them. So what do? Agility and the ability to course correct. We hear a lot about the agile organization when it comes to tech companies and how they develop apps and they just roll things out. That agile mindset applies to finance as well. It applies to how you do your job. And the thinking there is, don't wait until everything is perfect. Just go with something, start working on it, and if you make a mistake, go back and fix it. Sometimes your initial choices are wrong and have to be adjusted. You need to have a process, but you don't want to over-engineer things, and you don't want to slow yourself down so much focusing on the process. It's a tough balancing act. Now, you might have some outdated and inadequate systems because of your process. I'll discuss that a little bit more when I get to the technology slides. Now, your financial consolidation might change. This is more of an accounting issue, but it impacts us as FP&A professionals. If you have intercompany eliminations, for example, and you didn't have them before, you have to take that into account when you're building a forecast. Foreign currency translation. If you've never done that before, FX rates change during time. Are you going to use the current rate? Are you going to use a budget rate, an average rate? This could be something that's new to you. Or what if you have to go from GAAP to IFRS or back the other way around because of local statutory? So the point here is make sure you build a good relationship with somebody in your accounting department that knows this if you don't know it, to make sure that your forecasts are picking this up and you're not going to be caught by surprise. Make sure to gather information from other departments and collaborate with them. And my advice to you is to be proactive. Don't wait for somebody else to come to you. Go out to them, ask the question. Your business partners are looking to FP&A to be a support for the organization. So while you're asking these questions, don't just knock on the door every time you have a request because you're trying to understand something and then leave. Try to offer the services of FP&A as well. Building that relationship gets you valuable information, and that is the currency that you really want in a fast growth environment. And discuss some of your underlying drivers when you're doing one of these forecasts. You don't want the forecast to be a black box. If somebody comes to you and says, how did you come up with that? Having a slide or having something that walks people through that says, here's how I built this. Units times selling prices revenue, something basic or more elaborate than that. Because then people can ask questions and challenge your assumptions. And that's what you really want. You want that input from the organization to make your forecast more robust. Technology. Now, Excel is your friend until it's not your friend. There's a limit to what Excel can do. It is a very flexible tool. I love Excel. I'm sure the rest of you love Excel as well. But the flexibility is both its greatest strength and its greatest weakness. Financial models don't scale well in Excel. Consolidations can be painful and error-prone if you're doing them in Excel. So what do? Implement some new technology. But new systems can take months or years to implement. You often can't wait for that new technological solution to come down the pike. I'll give you one example from a prior employer. I was working at Wrexham, multi-billion-dollar British-based packaging company. We bought several different divisions and tried to roll them all up. And the corporate headquarters didn't give us any tools to do this. They locked down their consolidation tool and wouldn't let us put things in at the level of detail that would be useful. So my boss, who was CFO of that operation at that time, said, let's implement Hyperion. That'll solve all of our problems. Well, we spent $200,000 and 4 months of our time to implement a second consolidation tool separate from what the headquarters in London was doing. And during that time, we were trying to do everything manually in Excel and do a systems implementation. It was overkill. This organization was less than $1 billion in revenue. We didn't have to do a second consolidation tool outside of what headquarters offered. Something a little more agile, a little more just get going and get it done in a few weeks would have been a better fit for that size organization. But you need to have something. Having something is better than nothing. But the decisions you make now are going to impact what you have down the road. So when you're thinking about should I implement technology, think about what do you need now, what might you need 1 to 3 years from now. 5 years from now, that's too far in the future. There's a reason why accountants amortize software capitalization over a 5-year cycle, because these tools generally only last 5 years and they're outdated. And that's even more so nowadays with all the new software that's coming out. So if you're thinking about, well, in 5 years, maybe we could use it, no. If you could either use it now or use it or in the next couple of years. This is the last audience poll, so I promise I'll stop badgering you after this one. What technological tool contains your organization's most important KPI? And you can choose more than one answer for this question, unless the app doesn't let you, in which case pick the most important one. Okay. Excel. Excel wins again. It always does. It's interesting that about 16% said GL or accounting systems. I've never really, personally, I haven't used an accounting system for KPIs. I've used that for the raw data that feeds a consolidation tool or a data warehouse. But as you can see, almost half the people in this room said it's Excel. That's what they use to get key KPIs. So while it is flexible, you also need to think about how do you share that with the organization and how does it scale as the company grows. Now, what are some pitfalls? What are some things to look out for? The things that I'll be talking about in this section of my talk are things that I've actually done or I've seen other people do in my organizations. Stale metrics. So these KPIs, they can change over time, and sometimes they're not relevant anymore. Now, this is especially true if you have a new line of business. That KPI that you've used all along, maybe it doesn't make sense anymore. Startups. Startups don't generate steady profits or any profits at all in the early stage of the business. Any kind of profitability KPI isn't going to make sense for a startup. So adjust your KPIs to reflect the new business reality. And don't take last year and increase it by X%. Now, this sounds easy enough and pretty obvious, but the reality is this is where most people begin their budgeting and forecasting. They say expenses are going up 3% this year, or they're going up 5%, or market share is going up this much, and that becomes a starting point that you tweak. Well, when you're growing quickly, you can't rely on a percentage growth and make that the big picture focus of your entire forecast, because things change too fast and it simply won't work. Zero-based budgeting is something that I've implemented in the past. Consider doing that when you switch to a new rapid growth environment. Looking at every individual line item and understanding that can add a lot of value in this kind of situation. And consider doing that every year, not just for the one-off, because that does take more time, but the questions you ask yourself and you ask the rest of the finance team often provoke good debate and different ways of thinking about what is this expense, why do we need this? Now beware of adjusted earnings, especially publicly traded companies that have a quarterly earnings press release. They love EBITDA, operating profit, NOI, whatever you want. But there's a lot of things that are taken out of adjusted earnings. Depreciation that's the D in EBITDA. Well, you need cash flow to invest in new operations. That you don't see any new investments in EBITDA. There's other revenue and costs that are ignored for, let's say, GAAP reporting, but, or for, that are ignored for non-GAAP reporting that are in GAAP reporting, or you might ignore them for your ad hoc reporting. But actually, what you call other might be the most important cost or the most important revenue in your forecast. So just because you're getting pushback from your CFO or somebody on the management team to adjust this, take this out, make sure you have some kind of slide or analysis somewhere that takes that into account. That could be the most important part of your forecasts. One-time costs. Well, we had to buy a company and we had all these legal fees, so we're going to take that out and put that into one-time costs. Well, if you're acquiring a company every quarter, it's not really a one-time cost anymore. That's part of your business model, and that's something that you need to think about. One-time costs can bankrupt a small business. Fortunately, my current employer is a profitable company, but if you're in low single-digit EBITDA margins, you're probably bleeding cash somewhere, and that's not a good place to be. You might also have lack of familiarity with how to forecast these one-time costs because you haven't seen them before. What the heck is this? I don't know what this is. Then ask questions, become knowledgeable about that. Think about, I need to be able to understand what this is and explain this to management because this might actually not be a one-time cost, it might be a recurring cost. There's also less scrupulous people that know it's not a one-time cost, but they call it that because they want to mask poor performance. And your job in finance is to be the bearer of truth. So don't facilitate that because that can really undermine the organization. Just look at General Electric. They're probably the biggest offender of this and how far that company has fallen because all of their one-time costs were stripped out of the financials. And they are not a fast-growing company, but they are definitely guilty of some of these items. Now, how do you raise capital to grow your business? Well, if you're using debt and equity, when you time that capital can really have a significant impact on building your forecast model. If you raise capital too soon, you have cash sitting on the balance sheet not generating a return, or you have shares diluting your EPS calculation. So make sure that you build your forecast by month and not by quarter. That's one way to really capture when do you need that liquidity injection and use that to calculate all of your ratios accordingly. Another area is to classify variable costs that are fixed, that don't increase with the growth of the organization or vice versa. Always err on the side of conservatism, especially when you don't have full understanding of what the costs are. Now, deal models. Us and FP&A, sometimes FP&A runs the deal models and does the M&A work. Other times, FP&A simply receives that deal model from the M&A team. Then it becomes your job to integrate that into a budget or a forecast. Well, don't take them at face value. Different stakeholders might have different agendas. Sometimes people just want to get the deal done. And they want to make those numbers look as good as possible to justify the acquisition or the plant expansion. Your role in FP&A is to challenge those assumptions, make sure that you have an honest and open dialogue. That way you can stress test the assumption. Your M&A team might be the external bankers. Maybe they're doing the work for you. Well, they're always biased. They're always going to have an incentive to close the deal. And they will also exaggerate the cost savings or any synergies. So make sure to ask those questions, and when you build your 5-year plan or your 1-year plan internally, err on the side of being conservative. I've often seen those multi-year deal models. The first year it becomes the budget. Somebody says, well, why should we build a budget for this new acquisition? We have the deal model, the M&A team did all the work, it's already here. That's why you want to challenge the model during the M&A process. Once you have that done, that is your budget for the next year. Finally, use discrete financial statements. If you're doing anything with regards to a new acquisition or a rapidly growing division of a company, don't lump them together. You want to have 2 separate forecasts, do them on their own, and then add them together at the end. If you lump them together, you will lose all the granularity and you won't get a good result. So after the deal closes, take ownership of the budget or forecast. Now FP&A is responsible for this. Now, even if you were against the deal and you thought, this is a terrible idea, why are we going to buy this company? You're still responsible for the budget and the forecast and the numbers. People are going to hold you accountable. Review the numbers monthly, or maybe even weekly if you have to. Often the biggest surprises happen early in an acquisition because you're not familiar with the numbers. So if your reforecast cycle is every quarter, don't wait every quarter. Look at it every month. Ask a lot of questions. And share whatever lessons you've learned. Because if this doesn't work, your company is probably going to go out and buy somebody else in the future. So if you said, well, this forecast didn't work for whatever reason, talk about it, share that information. That can be useful going forward. Now, how can FP&A help in this kind of environment? Communicate externally. Now, if you're working in a corporate FP&A function, this is most relevant for you. This might not be relevant for everybody if you're in a smaller organization or if you're in a division of a large company. But corporate FP&A is the one group that looks at all the information and makes the bullet points and gives the investor relations team and the CFO all of their catchphrases. So anticipate what questions you might get from analysts covering the stock. Have that ready to go. If you have a quarterly earnings call, you know that analyst is going to ask a whole list of questions about this new acquisition. If you've thought about all those questions yourself and you've asked them of the M&A team and everybody internally, and you have a nice Q&A ready to go, that puts your finance team and your CFO in a really good spot because they are going to be able to answer those questions and they know that you thought about all of this stuff through the process. And don't assume people externally are going to understand your business model, understand why you did this. You have to explain that to them if you're in some kind of corporate communications or corporate FP&A role. Your business model has changed. Explain how it's changed. Explain what the new KPIs, the new ratios, the new way of looking at things are going to be. In addition to communicating externally, communicate internally. FP&A knows more about the company or about your organization than pretty much anyone else. You might not realize that, but if you're going into your financial system, you can probably see most of the data or all of the data. You see how all the pieces come together. Most people in the organization don't have that level of access or that level of understanding. If you were at the keynote Sunday evening with Damon John, he was talking about us in the audience, finance and legal. Those are the ones who had the best pitches. Those are the ones who were, because they could see everything and put holes in everything. So put holes in everything, just like he said. But be selective when sharing data, because there is information overload concerns, and there's also confidentiality concerns as well. Now, the presentation style and the topics are key. Tailor the information to your target audience. The board needs to hear something different from the office staff, who needs to hear something different from the plant employees. There was a good talk at the FP&A luncheon yesterday about hide the pill in the peanut butter. So that was the catchphrase that stuck in our minds for those of us who were listening to that yesterday. The idea behind that, if you were not at the FP&A lunch yesterday, the pill being, this is the medicine or the useful information you're trying to communicate, but that needs to be covered in a story or something that's going to catch the attention of the reader, of the listener, of your target. So think about, as you're talking about the rapid growth, what do you want to say here? Incentive plans. Sometimes FP&A is brought in to help with sales bonuses or compensation or other plans. This becomes more important when you're growing quickly, because if you have an unrealistic growth target, this could demotivate employees. If your sales team says, we're going to grow 50% this year, and then the budget becomes 50% growth and you only grow 30%, well, 30% is a great year. You did really well, but nobody gets paid a bonus. That's not a place you want to be. I've personally seen that happen before. So you can partner in FP&A and work with people in the organizations to have realistic targets. Easy targets don't stretch the organization either or help them achieve their full potential. Everybody likes easy targets because they get paid more money. But that won't, if you have any kind of long-term incentive compensation or any kind of equity in the company, that will hurt you in the long run. And think about some of the variability. What's the upside and what's the downside? How can things change, and model some various scenarios. Share that with other people in the organization if things go really well or if things don't go well. Question things that don't make sense. I've already mentioned this several times during the conversation. That's a key part of being successful in FP&A. Stress test multiple scenarios, exchange rates, interest rates. This is true of any forecast, not only in a rapidly growth environment, but that's how you gain knowledge and gain more confidence in your forecasts. Now, success is possible. Focus on the key drivers that impact the financial statement. Don't waste your time on things that don't add value. You need to understand what those key drivers are, and you get that from understanding your business. Go slow to go fast. What does that mean? That sounds like a contradiction. Focus on the big picture and what is your strategy, and then carefully and slowly pick what are the key drivers that are going to influence your forecast. Once you know what those are and understand them, put your efforts in to forecast those correctly. Are you going to steal market share? Are you trying to be a cost leader and cut your costs? Are you trying to go into a new market? What are those things? So you can grow with discipline and have a plan. My prior employer before I came to Fresh Products was Welltower. So I was there for 6 years, from 2011 to 2017. They grew from an enterprise value of $7 billion to $41 billion and did their first international acquisition in 2012. So what did they do? People, process, technology. They hired talented people, and they built a culture that empowers people to make decisions that benefit the whole organization. Welltower is headquartered in Toledo, Ohio. This is an old Rust Belt industrial city, not a place where you'd expect to find an S&P 500 real estate company, one of the top 10 REITs in the S&P 500. So they overpaid for talent. They had the luxury of being able to do that because they were a profitable, successful company. They went out and paid a lot of money and got all the best talent in town. Maybe you can't do that at your organization, but if that's an option available to you, use them. They improved processes as required. So when I started there, their internal audit department was one person. That was clearly insufficient for their growth, so they hired a very talented VP of internal audit, and he built a whole team out. And when I started there, I was in charge of their SEC reporting. That used to be outsourced, the whole thing. So for 3 years, I left FP&A and filed 10Qs and 10Ks for them. And then I hired a team and built all the processes such that now that we are a large, successful company, you can't rely on one person to do everything, and you can't rely on this person knows how to do it, just ask that person. Instead, there has to be a formalized process. We didn't have a close calendar when I started there. Sounds basic enough. Because you need to do the same things successfully over and over again so you can get those things out of the way, and then you can focus on your growth. They also invested substantially in technology. While I was there, I led 2 financial systems implementations. One was HFM, Hyperion Financial Management for Consolidation, and also Hyperion Planning. We also used several cloud-based software, such as SuccessFactors for human resources, Salesforce for sales, and Concur for travel. We didn't have any of those things in the prior 6 years, before I joined the company. During the 6 years I was there, all of those things were added. You need to have good technology if you're going to grow and become a mature, successful company. The finance function at Welltower focuses on what's important. So not every organization can do this. Sometimes an old report or an old analysis keeps getting generated, doesn't add any value, doesn't tell you what you need to know. We had a good culture where if something wasn't useful, we just threw it away and we got rid of it. And the culture also valued insight and intellectual honesty. That's a phrase that I think a lot of companies struggle with. You want to have a conversation with people and discuss the facts and not have to worry about political jockeying and people trying to defend themselves. Few places that I've seen do that well. Welltower did that, and that helped make them successful. But Welltower is also not done. You never get to a perfect place. You're always going through a journey of growth. We used the FP&A maturity model when I was there, and there were many areas for clear improvement. And that growth pattern that I showed on a previous slide was from foundational to emergent to optimized. When I left Welltower last year, they were in the middle, emergent for most of the categories. So we had moved from foundational to emergent, or from small to medium in terms of our level of sophistication. Still a lot more work to do. And finally, I'd like to conclude with where I am now and some of the current challenges that I'm facing. So my entire career, multi-billion-dollar companies. Now I'm working at Fresh Products. I'm the CFO there. I joined there in July of 2017. Our sales tripled over the last 7 years, and our forecast is to double again over the next 3 years, with the goal of having $100 million of sales in 2020 for an annual CAGR of 21%. At a small company, you have fewer resources. So thinking again about people, process, and technology. You have to roll up your sleeves and do it yourself. There's not going to be a lot of other resources that you can tap to do something. The FP&A team is me right now. I do the budget. That's it. It's just me. You can't delegate to other people. That means you have to pick and choose what is important. What analysis do I need to have? What analysis would I like to have? And if you don't need to have it, don't do it. Speed versus accuracy. 90% accurate is better than nothing. I think that's really important. You need to have some kind of actionable information. The goal is not to have every number tick and tie perfectly going forward for the next 10 years. If you have an actionable insight that you think is meaningfully accurate, share it with the management team. We also don't have a lot of technology. We do most of our work on Excel. And as you saw on a previous slide, about half of you are doing most of your stuff in Excel as well. We don't have a giant consolidation tool, so we have to be comfortable with having the versatility of Excel. Finally, FP&A is not a separate function. It's integrated into the business. And some folks would say that should always be the case. FP&A should always be integrated into the business. But that's especially true when you're in a small organization. People wear multiple hats. And oftentimes you're asked to do things that are outside of your comfort zone or outside of your actual job description. And even if you're not at a small company, you might be at a big company that acquired a small company. So if that's the case, and you're a corporate FP&A asking questions of folks at your small acquisition or your small spinoff, keep in mind these lessons, that they don't have the same resources as you do and might not be able to answer questions in a timely fashion. So in conclusion, be flexible and adapt to changing conditions. Be agile. True of any environment, more true today than it was 10 or 20 years ago, especially true if you're growing rapidly. Update your models and your forecasting techniques. You're going to learn new things as you progress. Don't just build a model and rest on your laurels. Keep changing it. And don't hold down your important foundational work until things quiet down. You're probably going to remain busy a lot longer than you expected. You need to get going on that work now. And don't assume you have all the knowledge you need. Ask lots of questions. That is the key of any successful FP&A professional, asking lots of questions. Thank you. Here's the CPE code for those of you who are looking to get CPE. Any questions or comments? Don't be shy. Last chance, I'm leaving. Yes. So the question in the back was, how do I work with the Treasury team? Let me answer that question about my prior employer, because I'm at a small company now. Very closely is the answer to that question. And we actually discussed this in an FP&A roundtable earlier here at AFP. In FP&A, you're often forecasting an income statement or a balance sheet. And the most important line on the balance sheet is cash. So you want to share your cash forecast that you have from constructing your financial model with Treasury and get their cash forecast. My experience is that there's often a big disconnect because the treasury team doesn't know about the investments that are going on in the business, profitability trends, seasonality, things like that. So you're going to look at the world one way, and they're going to look at the world a different way, and you want to share that information. Now, of course, they're going to be aware of big things, such as if you're going to acquire a company or issue debt or pay off debt, and, but they might not know about some of the smaller things that are going on and some of the trends that are happening. So I would suggest meeting with your counterpart and the treasury team on a regular basis to build that dialogue. Yes. So the question was suggestions for good FP&A software for planning and forecasting. That is changing quite a bit. If you don't adapt, you become a dinosaur. So I am a huge fan of the Hyperion suite, but that I've done 3 different Hyperion implementations in my career, but Hyperion is a tool that's good for consolidations. It's good if you're at a corporate headquarters or if you're at a larger organization. Doesn't work as well in smaller organizations. Currently, where I'm at now at Fresh Products, we're using Power BI because that gives you a lot more flexibility to export data from the GL, put it into a data warehouse, then do visualizations on it. One of the trade-offs of Power BI is that if you want to do analysis and what if, you still have to do it in Excel. There are several new cloud-based softwares that have come up in the recent years that seem to allow you to do that kind of analysis in the cloud in real time. Unfortunately, I can't answer your question because I'm not familiar with those, but there's lots of folks here at the conference trying to sell you that stuff, and I think that's the future. I think the idea of investing 4 to 12 months in a big implementation and spending a 6-figure sum on consultants is a thing of the past. So even though I like that software, that's probably not the future. Yes?
You offered lots of good tips for when you're in this high growth phase. I'm just wondering, in terms of the actual number that you can put to this, there's so much uncertainty when you're perhaps got a new product line, something completely new for your organization. You really have, there's no historical data, nobody's sure how it's going to go. What kind of tips do you have in terms of actually forecasting so you can create a plan that's meaningful for the organization?
I'm actually going through that right now because we just launched a new product that is completely unique and there's no competitors. What I found work is having different scenarios, like a low, medium, or a high, and thinking about what if this exceeds our wildest expectations? How good could it possibly be? Now, of course, that scenario sounds great because it makes the company a lot of money. But you need to feed that to operations for capacity planning to think about, do we have to buy new equipment, hire new people, and tell them, be ready for this. It might not be this great, but this could happen. Similarly, on the low side, what if this is a bomb? What if it's a huge failure and it doesn't do very well? Are we prepared to stomach losses as this product takes a long time to reach fruition? If it's not successful in a medium case. And I think if you are communicating that with PowerPoint slides, presentation, whatever your format is, here are the different scenarios, and tell a story for each scenario, that will get better input. You can't stick to just one number or one forecast in that situation because there's too much variability, like you said. Yes? Well, many different systems have an Excel add-in that grabs information from the database. Hyperion's Excel add-in is called SmartView. There are many other tools that do a similar thing. So that gives you the comfort of knowing that you have a reliable set of information for your actuals that is locked down, but then you can take it into Excel and do your what-if analysis and do all your stress testing and modeling. And when you finally decide on, okay, my budget is done, my forecast is done, you can push it back to the system and you can retrieve your forecast or your budget to do your variance analysis. So that's why I like tools like that, because it's a very dangerous place to have a budget or a forecast in an Excel spreadsheet where only you have it or only your team has it. You want to have the appropriate access to the appropriate people, but other people to see that, because that's valuable information. People have to know how they're tracking across the organization. So if you can store it in that database and give it to other people, that's really useful. And that's why I like that particular tool, is it gives you the ability to send your budget from Excel back to the system. And I really liked that feature when I was using it. Yes. I forgot to repeat the question for the last two people. Thanks for the reminder. So this question was accountability for the forecasts. That really depends on the culture and the politics of the organization, and ultimately who decides what is the final budget. My experience is you have a corporate headquarters and a divisional headquarters, and there's a negotiation and a battle that goes on over what should the budget or forecast be. You and FP&A, your role is to say what you think is reasonable or achievable or realistic. This is what you think is going to happen. But ultimately, those other people are probably going to make that decision. Another important consideration is the budget tied to the bonus, or is it simply a tracking mechanism as a target? More enlightened organizations have been detaching budget from bonus. So the budget is simply the tool to say, here's where we think the year is going to end up. But if an executive or a member of the management team is going to get a bonus, it's based on this number. And having a flexible budget that goes up and down during the course of the year in response to changing conditions. And then the bonus may change as well if the world changes. But I've seen a lot of dysfunction with regards to your question about what if there is a disagreement about what the budget should be and who ultimately owns that number. My experience is the corporate CFO usually makes the final decision. All right, well, it is 3 o'clock. Thanks for your time, everyone.